So any sum of partnership that will come, you will first have to see which type of a question it is. If it is a sole trader plus sole trader. If it is a sole trader plus sole trader, that means it is a question of merger. Your first step, you have to decide whether it is merger, whether it is admission, whether it is acquisition. First thing you will decide that. Sole trader plus sole trader merger is very easy. First thing you have to find out is you will have to find the net assets at the valuation that you are going to take it over. That is called what? NATO. What is it called? NATO. Net assets taken over. Sidra,
Yes.
first thing you have to find out is the NATO, which is called the net assets taken over. And this NATO will become the capital account balances of the new partner. Let's take it with an
Okay.
example. Every sole trader would have his non-current assets. He will have his current assets. He will have his current liabilities. Are you with me?
Yeah.
Every sole trader will have his non-current assets, current assets, and he will have his current liability. Suppose one partner is A, the other partner is B. Non-current assets plus the current assets minus the current liabilities minus the non-current liabilities will give you the NATO for A. I'm
Okay.
repeating it. Whatever is the new value, you will take the new value of the non-current assets, current assets, you will minus the current liability, you will minus the non-current liability, you will get the value that A is going to get in the new business. This is called the NATO of A and this becomes the capital of A. Are you with me?
Yeah.
Okay. Then you will calculate the same thing for B. Non-current assets that is taken over, current assets that is taken over, minus the current liability, minus the non-current liability, you will get the net assets taken over. NATO. What is NATO?
Net asset taken over.
Net assets taken over. So this you will get the capital account balances of A and capital account balances of B. Together will become the capital of the partnership. Are you with me?
Yeah, miss.
So what is happening? I have a company A, I have a sole trader A, I have a sole trader B, and they both are merging together to become AB. Are you with me?
Yeah.
AB will have the non-current assets of both A and B together.
Yes.
AB will have the current assets of both A and B together. They will have the current liabilities of both A and B together. What will be the capital? The capital will be NATO that you have to calculate. What is NATO? Net assets
The pro
taken over. What is NATO?
net assets taken over.
Net assets taken
So
over.
that's
Yeah, tell me.
assets minus, right?
Total assets minus the current liability minus the non-current liability, but all of this will be at the revised value.
Yeah, all right.
They will give you a new value that which you have to take over these assets to the partnership. All of this will be at the revised value. So the NATO is actually what? It is the capital account balances excluding the goodwill adjustment.
Okay.
Okay. Now can I say that A can have his own set of goodwill? Can I say that A can have his own set of goodwill?
Yeah.
B can also have his own set of goodwill.
Yes.
Okay. So first thing you will find out is the capital account balances excluding goodwill adjustment. Then you will do
Okay.
the goodwill adjustment. What is the goodwill adjustment? Whatever the value of goodwill that A is bringing and B is bringing, you will raise the goodwill, that is called goodwill raise. You will add the goodwill raise, you will minus the goodwill written off, and you will get the new capital balances. Let me take you with an example. Suppose the NATO of A is 100,000 and the NATO of B is how much? 150,000. So the capital account balances becomes 250,000. Are you with me?
Yeah, miss.
Capital account balances becomes 250,000. After that, they will tell you that the goodwill that A and B together will get into the business is say about 100,000.
Okay.
Okay, but goodwill
Yeah.
is never shown in the book. So what do? We first raise the goodwill and then we write off the goodwill. What do? We
Raise
first
and then
raise the goodwill and then write off the goodwill. So whatever goodwill they are bringing in, we will add it because they are increasing the value of the capital. So they are not only getting money with them, they are also getting a goodwill, something that can bring profit to the business. So we will add it. So we will add the goodwill raised. How much is the goodwill raised in my example? 100,000. But then the partners decide that they don't want to show goodwill in the book. So when the partners decide that they don't want to show goodwill, that means what?
miss.
If the partners decide, see, A is getting some goodwill along with him and B is getting some goodwill along with him. So when they are getting some non-monetary item along with them, what do? Is we increase the capital account balances, and we increase the capital account balances. That means we say we are raising the goodwill. Are you with me?
Yeah.
Okay, are you with me? So A and B are going to get two things along with them. What are the two things that they're going to get along with them?
The goodwill and
First,
the
they are going to get NATO, the net assets that is taken over. That means the non-current assets, current assets minus the current liability. A and B are going
yeah.
to get two things along with them. What are the two things that they're going to get along with them? First is the capital and second is the goodwill. A and B are going to get two things along with them. What are the two things that they're going to
Yeah.
get along with
For
them?
capital and the goodwill.
First is the capital and second is the goodwill. Goodwill,
Yeah.
you have to treat it in your books. So what will you do? First, you will increase their capital by raising the goodwill. Okay.
Yeah.
So you will raise the goodwill. And after that, if the partners decide that they don't want to show goodwill, what do they decide? That they don't
They
want
don't.
to show goodwill amount in the books. So what you can
Yeah.
do, you can raise the goodwill, and third thing, you will minus the goodwill. So when you add, it is called goodwill raised, and when you minus the goodwill amount, it is called goodwill written off. What is it called?
Goodwill written off.
So you will minus the goodwill amount and then again you will get 250,000. So you will say, Miss, what is the sense of adding a value and then removing a value? So it is not necessary that they both get equal amount of goodwill. There could be a difference in the amounts of goodwill. So you raise it at a different amount and you write it off at a different amount. When you raise it in the actual figures or the old ratio. And when you write it off, you will write it off in the new profit sharing ratio. That is what they have agreed to share in the future. And you will get revised capital account balances. Okay. So your whole
Yeah.
thing that you're doing this calculation is for what? To find the capital account balances of the partners when the sole trader is merging with the sole trader to form the partnership. Can you tell me the process of it? Yeah, Umesh, you tell me. First, you calculate NATO. How do you calculate NATO?
We'll take the total assets minus
Non-current
total
assets plus current
plus current
assets minus current liability minus non-current liability. This will give you what? NATO.
NATO.
NATO is what? Capital account balances excluding goodwill. What is it? Capital account balances excluding the goodwill. Net assets taken over or transferred. Then after that, what will you do?
You'll see the amount they have, like the goodwill raised.
You will raise the goodwill. So when you're raising the goodwill, you are adding it to what? Adding to the capital.
Additional, yeah, capital.
When you're raising the goodwill, you're adding it to the capital. Then what will you do?
Then you'll subtract the goodwill written off.
Written off. So that means you are subtracting it from capital.
Yeah.
Okay. So suppose if this is your capital account. If this is your capital account of the partners after the merger A and B, where will the NATO be? Which side? Debit side or credit side? Capital account always have what balance?
Credit balance.
So the NATO will be on the credit side. Okay. Then you're raising the goodwill. Raising the goodwill means what? You're increasing the capital.
Additional capital, so credit side.
So you're raising the goodwill. So goodwill raised will come on which side? Goodwill
Credit.
raised will come on the credit side. Then you're writing off the goodwill. So writing of goodwill will
So
come on which
debit.
side? So goodwill
Debit.
written off will come on the debit side. So basically, when you're increasing the capital, which side you will write it? When
Credit.
you're increasing the capital, credit side. When you're decreasing the capital, debit side.
Debit.
So goodwill raised will be on which side?
Credit.
Goodwill written off will be on which side?
Debit.
Debit side. Okay. Now what will I'm doing? I'm giving you a sum wherein you have to prepare the statement of financial position of the partnership firm after the merger. Read the question properly, merge it. When you're merging it, that means you're preparing a new statement of financial position. And when you're merging it, you're basically finding what? New capital. The new capital balances. Try to do it. I've already shared the PPT with you, Sidra. You can do it on your PPT as well.
Yeah, okay.